Today, I have Dustin Miles, co-founder of Momentum Multifamily, on the show. And I'm excited to talk to him because Dustin, not only have I known Dustin for a number of years, but he's been doing this for over a decade. He has 18 multifamily deals under his belt. And we're going to talk about what it was like investing in the golden age of multifamily investing and what it's been like in the last couple of years. So, if you are someone who has multifamily deals being pitched to you right now, and specifically if they're referencing tax abatements or preferred equity as how they are making their money or how they're making their deals work, this episode is something you need to listen to. Now, before we jump into the interview, if you haven't already, subscribe to the channel and then go check out the link below for the passive investor event. And if you need some help doing due diligence, I have that due diligence guide below. So let's hop into my conversation with Dustin right now. All right. Hey, Dustin, thank you for being on the show today. So everyone, we have Dustin Miles with Momentum Multifamily. And I just like to start off with letting Dustin introduce himself and give his origin story. So Dustin, let's go.
Yeah, gosh. So I live in Fort Worth, actually not too far from Jared. I've known Jared for a number of years, but I grew up here, went to UT Austin for engineering school, used to be an engineer. But I've always been pretty entrepreneurial. As a little kid, I had a candy business. So I was 8 years old, and I have a sweet tooth, so I didn't eat any of the candy, which was probably impressive in itself.
More impressive than your sales, possibly.
Yeah, probably. Yeah. But my bus driver called me the Candy Man, so which is kind of funny. And I just had a bunch of different businesses growing up. In college, I didn't know anything about them, but I sold Pokémon cards. And so in my apartment, I had a wall of Pokémon cards. And so, friends would, be like, hey, are you okay? So, it was definitely, interesting.
So how did you get into selling Pokemon cards? Because I'm kind of the oldest, Pokemon cards were introduced at the prime age for me. And I know you're a few years older, but you weren't really into them is what you said. I was just as soon as I could buy a pack of Pokemon cards, I went and bought a pack of Pokemon cards.
Yeah.
But I never sold them, right?
Right. It was, pure just opportunity. So the background of that is my dad had a comic book store. He also sold Pokemon cards and baseball cards and all that. And so anyways, so this was late 90s, and I was a little tech savvy, more than 90% of everyone, but within the tech circle, not very at all, really. And
more than the average, way more than the average person, but not competing with the crazy people.
Right. Yeah. And I'd worked at FlashNet, for a number of years. So I, gotten some exposure and all that. But anyways, I was trying to get my dad to start a website. And I was like, hey, I'll put it together for you. I think this would be really good for your business because you're limited. This is back in the day. This is before internet. You buy anything on there, they're going to steal all your information. That was kind of the thought process. And so I was like, look, you're dependent on the people that drive by your store, in North Dallas. I was like, what if you could make sales while you sleep? And anyways, he wasn't into it. And so I was like, well, can I build a website and can I buy product from you and sell it through there? He's like, yeah, sure. And shocking, or I guess not shocking, I started outselling him on the Pokemon front pretty quickly because I could, sell all around the world and I could get sales while I slept. So it was a little weird, I guess, going to school. So I had 2 backpacks. I had my backpack full of Pokemon cards that I would be going to the post office with. And then I had my backpack full of engineering books. So,
That's funny.
Made some money and the fad died. And then I just, I wish I would have kept the leftover Pokemon stuff. That I think it's worth a lot.
Yeah. Now. I remember I was young and I was finally, it had been a couple years after the fad was the highest. And I was like, you know what? I have some leftover cards, a couple that are worth 20, 30, 40 bucks and nothing crazy, right? It's like, if I'll sell those on eBay, I'll, make a couple bucks off of them.
Well, I didn't know what I was doing, didn't know how to set a reserve, and so
Uh,
accidentally sold a couple of cards for like 1 penny.
oh no.
So so it like cost me money to sell these cards,
Yeah.
because I had, it wasn't a big deal. It wasn't
Yeah.
actually a big loss, but it was a learning experience. So it was kind of
that-
funny.
That's hilarious. But
So
yeah, I got out of college and, started going to different real estate conferences and all that. It was, the variety of conferences at the time was someone was selling some CDs, and
mm,
when they were done, these guys were fantastic salesmen. So you had to leave your wallet at home. I mean, these guys were good. And
yep,
anyways, you have never out or I don't know if you guys had ever seen this, but so you're at this conference and you're sitting there, and I mean they're such good salesmen, and they're so good at trying to think of the word, but
tactically.
the
Oh,
scarcity
scarcity.
mindset.
Okay.
Yeah. And so they're like, we only got what we have back there, and then it's done, and blah blah blah. I was like, oh, I'm sure you'd be more than happy to sell some other CDs at $1,000
Yep.
pop or whatever. But so they would have, I mean, literally, people would be running to the back of the room to go give these people money. I mean, it was super interesting just how well these guys could sell. Anyways, I learned very quickly that, and I was pretty thrifty and maybe still am, but I was like, I'm not going to pay a grand. And it was just interesting just to see people fly to the
Yep.
back. I mean, it was crazy. Anyways, so that was my kind of first touch of real estate. And I guess kind of backing up even before that, when I was a little kid. So I've played soccer my whole life, and this one kid that I played soccer with, his family owned a skyscraper in downtown Fort Worth, and they owned a bunch of other commercial property. And I played soccer with this kid, and my 8, 10-year-old brain was like, okay, these are. I remember going to his house, monster house. You'd probably actually know it, Jared, because it's kind of up on a hill off of 183. Anyways, but it's this big white house, and it's I think they've built other homes, so it's not as easy to see now.
Yep.
But anyways, his family did really well. I remember going to a birthday party at his house. I remember thinking, this is maybe sounds weird, whatever, like a little kid, but I'm like, okay, these people are normal. They can't fly or anything like that. I'm like, hey, this was, if they can do this, why not
Yep.
me? And so very early on, that kind of stuck in my little brain. And so got older and all that, and so I don't know, I've always had a fascination with real estate. I remember
hmm
riding my bike around town. That was what you did back in the summers, like you just ride your bike around. I remember like, who owns all this stuff, and I'm like, oh, that guy I played soccer with, his family owns some of it.
Yep.
And so anyways, got into, so after graduating, went, did the seminar thing, and then, tried to hire a few coaches. Some, one of them went really well. A few of them did not. We paid them, and then they disappeared. And then, and then I found a group that they had an office. They were on the radio. I'm like, okay, I know where you are. You're not going anywhere. So,
Sounds
and
like lifestyles. Was that who
it
it
is.
was?
Yep, yep, yep. So, had some success there. Ended up buying half a dozen rentals and
Yep.
flips. Made some good money. It helped. I was buying in 2009, 2010, and I was ready. I'm like, okay. I was working as an engineer at Lockheed, and
Yeah.
hey,
A
how
good
do I?
W-2 income
Yeah,
in a good
yeah.
market for an investor.
Yep. 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 It was a good job, and had some flexibility, especially kind of the other every other Friday off helped a lot.
hmm
And I was ready to grow and expand and all that. And one thing that was attractive about lifestyles is they taught you how to do apartment investing as well. And so started investing passively in 2012. That was I was also signed on the loans. I was super nervous. I mean, I've never signed on a multi-million-dollar loan,
Yep.
before. That was scary process. I had never invested. I invested 50,000, and that was
Hmm.
a very large sum of money compared to what I had. And anyways, that went really well. Did another passive investment, and then I was geared up and did my first real estate syndication where I raised the money and signed on the loan and
Yep.
all that good stuff. Did that in 2014. So yeah,
Okay. All right. So we are over a decade you've been doing this now since the first multifamily syndication.
yep,
Uh,
yep,
so that's kind of one of the reasons I wanted you on here is we've mentioned in the other episodes, just the life cycle of where multifamily is right now. So we're definitely going to
hmm
talk on that today. But tell me about those early days of multifamily syndication. What were some of the maybe the biggest like hurdles or challenges or misconceptions you had when you first started?
yeah. So obviously, I was new, it was fresh. I didn't have a whole lot of perspective. So some interesting things. So uh, I can't remember exactly where debt was at then, but it was probably in that 5% range ish
Hmm.
or so.
Yep.
And so if I would have had the perspective of just at a glance, if you look at it's called positive leverage. So it's the delta between where your debt is at, which was, we'll just call it 5%, and where the cap rate that you're buying at, which at the time was 9 or 10%. So you had a 4 or 5% spread, or
Yep.
400 or 500 basis points, but you had a huge spread.
Yep.
And so from that perspective, the cash flow was phenomenal.
Yep.
We would walk, we'd walk into these deals, and honestly, the expectation at the time was 10% cash on cash. That was the bare minimum, which
Mm,
people, a multifamily deal now would, I mean, they would, jump all over. I mean, you'd be subscribed in,
yeah.
2 minutes. So it was definitely an interesting time. I think that it was more of, at the time, it was so you could get in without being all that sophisticated, which I think I'm a smart guy and all that, but like, there's a learning curve to everything,
Yep.
and it helped that I could get in and there wasn't a huge learning curve at the time. I feel like, you're kind of, you could have graduated elementary school per se, and and not be super overly sophisticated. It's obviously, you want to be educated, and you
Yep.
want to kind of have a team of professionals that help you with a few different things, but you didn't have to be overly you did like now you really need like a master's degree, so to speak.
Master's degree in real estate. Yeah. Yeah. Or
Yeah,
in multifamily syndication, even specifically.
yeah, to get in and to be able to purchase and be able to operate. It's not back in the day, like, people didn't team up. It was like a guy like me or whoever, would put a deal together. Now there's a team of people. I mean, we have,
Hmm.
you know, we have we have a pretty decent sized team of people that we're doing bigger deals now, but it takes a lot of really smart people that are very specialized in a field
Hmm.
to really get these deals across the finish line. So there's been a maturation process, big
Yep.
time for sure. I think that there was a lot of real easy, low hanging fruit. At the time, we're both in the DFW area. In 2014, a lot of the deals hadn't really been renovated and things like that. So
Yep.
there
A
was
lot of meat
there
on
was
the
a lot,
bone.
yeah, tons of meat on the bone. There were a lot more mom and pop operators because deals were cheaper back then, and a lot of those guys had owned stuff for a while, and they bought it pretty cheap. And so there was just not a whole lot of not that mom and pops can't be sophisticated and professional
Yeah.
and all that, but a lot of times they've owned them for a long time, and some of them didn't have debt, or they had very little debt. And so you know they didn't have to tweak everything in order to get a return. They, had owned the stuff forever, and so it wasn't, a huge deal for them. So, yeah, and then one kind of, at least the groups that I was a part of, the thought process was a lot of people were concerned about the GFC kind of replaying and coming back. And so that, looking back, I wish I would have bought everything under the sun, because, you bought 9 or 10 caps, and debt was relatively cheap. And so you had a huge positive leverage. And so,
Mhm.
your cushion, was massive, and you didn't have to, tweak every little thing in order to get, your return out. So,
Yeah. Okay. You said GFCs. What do you mean by you're afraid the
oh,
GFCs were coming back?
yeah, sorry, great financial crisis.
Oh,
So,
okay. All right.
yeah, so, everyone was thinking that the economy was potentially, not everyone, but like there was a concern, like, hey, what if the economy,
Yeah.
tanks again?
Well,
What does
there's,
all this look like?
it was what the kind of the sayings were there's typically a recession every 7 to 8 years. And we
Yep.
went on a 12-year spree before anything happened,
Right.
essentially
Mm-hmm.
10 or
Mm-hmm.
12.
Yeah.
Um, okay. So, from the LP or the passive investor perspective, right? So we're going to have we have listeners who are going to be like the highly paid W-2
Mhm.
earners. We're going to have the small business owners, the doctors, attorneys, that might be newer to this. So from their perspective, what's something that you would want to share they should, you know, be thinking about, from your perspective of like you got in a down market that went up,
Mhm.
and we're going to talk more about this, but we're not there right now. So what's something that these passive investors who aren't experienced passive investors, what kind of questions should they be asking right now?
Yeah. So I think that there's a few things. A lot of people, and this doesn't help my cause at all. So I'm,
Yeah.
so I would, really pay attention to what I'm about to say, because it doesn't help me at all. So a lot of people like to flash their track record, and
Yep.
I think there's certainly merit and all that, but the problem, like what Jared had just mentioned, we had, some people kind of called it the golden age of multifamily, and so we had rents were going up like crazy. We had cap rates going down, and just to kind of reframe it, just, for anybody that just doesn't, not super familiar with how, multifamily commercial, properties are evaluated and all that. So there were instances, and rents were going up, and it's really hard to understand, you know, I mean, there's definitely merit for, like, I got in. A lot of people did not. A lot of people sat on the sidelines,
Yep.
and so they're, so should get a little bit of credit at least. But
Yeah.
uh, but if you bought it at 10 cap and you sold it at 8 cap, I don't have a calculator in front of me, but you could make a lot of money and you didn't move the NOI at all. A lot of people, did, and including myself. And so a lot of people, you'll hear about people who doubled and tripled their money. The market helped a lot, and the people who can flash that to our credit, like, we actually, we took
Yeah.
action, we got in
You
there.
got in there, you did deals, you made your investors money, and at the same time, what is it? A rising tide lifts all boats.
Yep.
You know,
Yep.
at the same, and they both can be true. You can have people who benefited from the market improving, and they also did a good job. But
Right.
you also have people who, like you're saying, they have the track record to flash on paper,
Right.
but it really was just the market, right?
Right.
Maybe
So
they didn't actually improve the property, but the market improved the value.
right, right. So you had people that you could have bought a lot and not super paid attention to it or knew
Hmm.
a whole lot about operations, and you could have done very well. And there were plenty of those, that kind of occurred. So, on the flip side, so basically COVID through now, it super hard operations wise. You had so you have rents flat or sometimes negative,
Yep.
and you had cap rates which were compressed going back up, and so you had basically you know the opposite
The
of
in
what you had during the golden age, and so it got very very difficult very
Yep.
quickly. And then you had insurance was going through the roof. Insurance used to be like it was $300 a door. You didn't even really have to talk to an insurance agent. Like it was
Mm,
just, or an insurance broker. It's just
yeah.
it's $300 a door. Now we have to do tons of work, and and we have for us we have enough scale to where we know what stuff's going to cost because we kind of have a portfolio wide
Yep.
policy. But if you don't, then it can be more challenging. Property taxes, can be more all over the place too.
Yep.
So it was kind of the last 5 years have been the polar opposite of where everything was, for the last, I don't know, whatever, 2012 to 2019 or so.
Yeah. All right. So that's interesting because I feel like a lot of our listeners are maybe naturally more in tuned with the single family market, right?
Hmm. Hmm.
And so the single family market just went straight up until middle of 22.
Right.
Um, because while there was a brief blip from COVID in
Hmm.
early 2020, that actually created the largest increase in values we'd seen in that like 2 year gap, mid
Right.
2020 to mid 2022. So when did that transition start on the front end, right? Because like what we're seeing is we're seeing the back end of the transition and what's happening to investors. But when did the front end transition start happening with like whether it was qualifications, whether it was insurance rates, whether it was the lending getting tighter? What did that look like?
Yeah, it was pretty challenging during COVID for sure. But the real time that so when you know single family had this huge boom right after
Yep.
COVID, multifamily also had a similar boom
Okay.
because money was dirt cheap. You had
Yeah.
basically free money,
Yep.
and that was the same, for single family. So once rates, shot through the roof, which they have for both, that's when it got extremely difficult very quickly for
Okay.
multifamily.
Okay. So there was some transitionary a little earlier, but really the big change in the lending market came in that mid to late 22 as well.
Yep. Yep. Yep.
Okay.
Yeah, it did. Yeah.
Okay.
Started rates started going up March of 22, and then
Yep.
just yeah, it was pretty challenging from
Yeah.
there on out. So
Might be a good way to say it. So, all right. So for anybody who's been a long time passive investor, specifically in multifamily, they're going to have seen the transition and
hmm
they're going to have felt it. And they're
hmm
probably going to have every single one of their sponsors have already explained what happened, right?
right.
Like, this is why, this is what's going on. But talk to the newbies right now, the novice investor who he has his buddy, his surgeon buddy's been bemoaning how terrible his multifamily investments have gone,
Yep.
or his office, his counterpart in his law firm, all he does is complain about how he's not getting his distributions right now. Explain what actually happened in the market, because it wasn't just multifamily, but I think multifamily, it was a combination of it being one of the hottest
Yep.
alternative investments plus being one of the biggest markets. Explain what happened and what we're actually seeing and experiencing right now.
Yeah. It's so part of the problem was so it got very hot. A lot of people, not everyone, but 95% plus of the market was they were doing bridge loans. And anyways, so a lot of people took on bridge loans. The thought process at the time was this was a very temporary hike, and things would come back down.
And a
Maybe
bridge
not.
loan meaning
Bridge loan means it's a 3-year loan. It's short term. It's
Okay.
floating rate. So you have to buy an interest rate cap. So the first people
You
that
or
really
you
felt
should consider buying an interest rate cap because not everyone did,
no,
or do
well,
they make you?
most lenders made you
Okay.
at the front end of kind of 22. There were a few lenders that you could find that didn't require it, and so the people that did that, they are the first ones that got burned, and they
Okay.
were at basically foreclosed on pretty
Okay.
quickly. So there were basically if you bought in June of 21 through about 23 or so, you were probably in a floating rate loan, and you bought basically kind of top of market.
Yep.
And since then, there's been about a 25% reduction in average, sometimes a little
Ooh.
more, a little less. Yeah, it's which is that's usually around the amount of equity that's raised for these deals.
Yep.
So if you bought during that time, there you have a few options. You have, and the reason so you have this reduction in value, and you have a 3-year loan, and so that train is the train track is is finite,
Yep.
and so you have a few options. You can do potentially a capital call. So if you've been in multifamily for a while, or other asset classes,
Yeah.
and they were bought during that period, capital call. You can bring in potentially preferred equity, but then you're like, okay, if you bring in preferred equity, typically they want to be paid. It's called a current return, so they want to be paid monthly. And so how do you generate
If you're already
that?
struggling, how do you take on an additional
Right.
distribution? Yeah.
Yeah. Yeah. Or there's GP loans. The GPs could put money in as well. Could be another option, or tax payments.
Yep.
And so we've done personally, we've done a combination, of a few things, and we were pretty we you know um to our credit, I think we started looking at the tax abatement process in December of 23, which we felt
Okay.
was very early. And I think that helped us quite a bit, because we were able to kind of secure tax abatements for our different deals, and I think that ultimately kind of helped.
All right. Well, talk about a tax abatement and what that does.
Yeah. So with the tax abatement, so the deals that we're buying, they're pretty large, and they have big tax bills, and we're in Texas.
Yeah.
So we
Which
have.
Texas has like the fifth highest tax rate in the country.
Oh
Just for
wow.
anyone who's not exactly familiar with that, it's the
Okay.
fifth
Property
to
tax rate. Yeah.
seventh. Yeah.
Okay. So we have some deals that the tax rate, property tax amounts about $1 million a year, and
Mm.
so kind of the exchange is you know people, affordable housing, you hear about in the news. We need more affordable housing, but and all of that. So this is I think a pretty smart. I think it's a definitely very entrepreneurial kind of effort on the cities, which are sometimes not known for their entrepreneurial spirit. But
Yeah.
I think it's actually a pretty smart way of affordable housing, and then it fortunately at the time it kind of helps property owners out that would otherwise be wouldn't be so pretty. So the way it works is property taxes. So for ours, property taxes were about $1 million. That basically kind of gets wiped off. There's some other bill or other fees and things. It's not just a free lunch.
Yep.
But in exchange for that, you basically kind of put a cap on some of your rents, and there's a
Mm.
affordability component for residents. And so it's a nice win-win for everybody, we think. And so that so once your property taxes go down, your NOI jumps up, and it means
Yep.
your value jumps up. And so that's how we've been able to kind of create, get things back to par.
Yeah. Okay. And I don't want to get too technical because I'm not sure I could understand if we got too technical.
Yeah.
But from our prior conversations, there's a couple of different types of tax abatement products,
Hmm.
and some of them might have varying levels of long-term certainty. Would that be but
Yeah.
what kind of questions should an investor ask if they're being pitched a deal where the guy's saying, "Hey, we got a tax abatement, we're good to go." Are there any questions they should double check or verify with?
Right. Yeah. So if you're with a local, so there's, and I'm not an expert in this, but like I've learned a lot in the
Yeah.
past, few years. And so there's kind of the way I see it, there's kind of a few buckets. There's PFC and HFC. I think I don't know the history exactly,
Sure.
but a lot of the PFC stuff has actually been around for a while. And so, but in general, if someone has a tax payment, you'll want to see that it's with a local housing authority.
Okay.
That's the key thing. So there's a bill that passed with Texas. It's called HB 21. You can look it up and then throw it into Chat GBT, and
Yeah.
it can give you a summary or something like that. But the crux of it is, so in that's going after not PFC, but it's after HFC or Chapter 394. And so the way basically they're trying to steer people away from out of jurisdiction or traveling HFCs. So
Okay.
what that means, you're like, what does that mean?
That's
And
exactly, yeah.
yeah. So that means that you have a tax abatement. Let's say your property's in Dallas,
Okay.
and you got a traveling HFC, and the kind of the sponsoring jurisdiction was out in West Texas somewhere. And so that would be an out of jurisdiction HFC or a traveling HFC. And so the bill is basically, that's all the stuff that you've seen in the news about the tax loophole and all that.
Mm,
That's what that's referring to. And the bill, that's what the bill is trying to correct, is it's trying to, hey, you got this, and all of it's not 100%. All of it's, there's still a lot of, all this is, this HB 21 came out in May,
yep.
so there's still a lot of moving parts here. But in general, they're trying to steer people towards in jurisdiction and local,
Okay.
approval.
Which would make sense. So if you've got a
Yeah.
property in Dallas, the
Yep.
state would prefer a Dallas-based housing authority be the
Right.
sponsor for your tax abatement because Dallas is going to be the one losing the tax revenue,
Right.
but in order to create the affordable housing, which
Right. Right.
that's
Yeah.
that's the goal.
It would be kind of like, for you, Jared, it would be like someone else saying how your dollars are spent or how much money you receive in income. That's
Yeah.
not, that's
Yeah,
not
someone
cool.
else saying they think it's a good idea for me to lose some of my money to help
Right.
someone else. A
Yeah.
third. Okay, that makes
Yeah.
sense.
Yeah.
I like the layman's terms. All the acronyms we'll let someone else remember, but basically, when you have someone pitching a tax abatement deal to you, you want to ask some questions. And the first one, or the most important maybe, is the housing authority that the tax abatement is through or sponsored by a local housing authority.
Yeah, and that could be a city or a county.
Okay.
So,
Okay, cool.
Yep.
And so is this is just kind of maybe a ancillary question, but is that housing authority that may sponsor that, are those the same housing authorities that give vouchers? Like,
that,
or is it a different entity?
Yeah, they can be. Yeah, for sure. Yep.
Okay. So it's just a different way to encourage affordable housing, right? Like, I know housing
Yes.
vouchers are, you meet all of our standards and you qualify, and we will help subsidize the payments for certain people.
Mhm.
Whereas we're going to actually, and that really doesn't increase your revenue other than giving you reliable revenue, a
Right.
housing voucher, right? And so the benefit of the tax abatement is you actually have an expense fall off of your P&L, which increases your net operating income.
Yeah, and one thing I want to specify, because there's people can, oh, it's you're gonna, it's Section 8 or whatever.
Mm.
And just because there's a tax abatement doesn't mean that not everyone has to have a Section 8 voucher. They just have to have a certain amount of
It's
income.
income based, not
Yep.
housing voucher based. Okay.
Right. Mm-hmm.
Okay.
Yep.
Cool.
Yep. Yep.
Cool.
So.
Cool. Yeah. So I know that's something I've learned from you. And so what's, as we're a couple years into this, what are some lessons you have learned going through this transition, right? Because this is the first major real estate shift a lot of people have seen, right?
Right.
Or if
Yeah.
you're old enough that you would have seen the 2008 shift, but you weren't in it as a participant, right?
Yeah, I wasn't a player. Right.
Yeah, you weren't a player in it. So what's something that you've learned as we're 3 years in?
Yeah. Well, there's a handful of things that, not some of it, we didn't know, so we bought newer product.
Yep.
That thankfully helped us quite a bit. Just because whenever you're looking at the tax abatement stuff, and we didn't know this because didn't even,
Yeah.
I didn't even know about tax abatement stuff, honestly, at the time. But with some of the tax abatement stuff, they like newer pretty properties. So that, kind of helps. Insurance, newer properties and insurance companies like sprinkler heads and things like that in the units. And so that, has helped us quite a bit. I would say one thing that I learned earlier from my just real estate career and all that, and I think a lot of people, because I've seen a lot of people that have gotten into the space, and honestly, yeah, you could kind of get away with it when rents were going up and cap rates were going down and all that, but they would buy in tougher pockets of town, which, you know, yeah, spreadsheet looks good, but
The upside looked better on paper.
yeah. But then when you get into operations, you're like, oh man, this is challenging. And
Yeah.
so I think, we've really focused on location, and there's been some instances where honestly, like, we could have a lot larger portfolio than we have now. And there's back. I'm like, I'm glad we didn't get a lot of those deals. We were number 2 or whatever on a lot of deals, and I'm like, oh, I'm very happy about that. But there were some deals that we've been, people have been like, hey, you can do this. I'm like, we just not comfortable with the location, honestly. And I'm like, I don't, I mean, if it was super, super, super cheap, maybe we'd look at it. But I'm like, because some of the deals were a newer deal, and they looked okay, but we know those areas really well. And we're like, our management company operates in those areas, and they're like, this is the toughest pocket, period. And it's just
Yes.
not worth it.
Yeah. I've had even in single family, you'll find those pockets in those neighborhoods, right? I had a client that had a bunch of duplexes, and we went and found one, and it was, I don't know, it was like a quarter mile away from 2 or 3 of his others. And, we're not thinking about it. And we buy this duplex, and the property manager that he used for all his others, after we got it, was like, oh gosh, I hate this area. This is like the
Oh,
worst
wow.
street in so it's
Oh,
kind of
wow.
stuff that, you know, wish we would have asked beforehand, right? So you knew that in advance, so it steered you away from it.
Yeah. Location is huge. We've really gotten big into systems. If it just doesn't, I don't know. We want to be able to grow, and we want to,
Mhm.
I guess, maintain our hair and not pull our hair out and all that too. And and honestly, we want to be really proud of of the communities that we're in. I mean, the
Hmm.
ones in Houston, they're all called the Henry. They're named after, my son's name's Henry,
Yeah.
and so we want to be proud of what we're, getting into. I mean, we have a lot of friends and family that join us in these deals too,
Yep.
and we just want to make sure that we're, if it's an area where we just don't think we can, hit our targets and achieve what we're saying we want to achieve, then we'll just pass. It's just not
Yep.
not worth the headache, because we're in these deals. It's not like I'm flipping a house. Like, we have to be prepared to be in these deals for 10 years. I mean, we
Yep.
don't. I mean, like, where we're at now, the deals that are really struggling, and like I'd mentioned, if you bought in 21 through 23, June of
Yep.
21 through 23, if you bought in rough parts of town, do you think outside equity, preferred equity is going to want to hop on those deals?
Mm-mm.
Probably. I mean, maybe if you're willing to, take a real haircut on equity and some other
Yep.
things, but like that's a real, anyways. So there is right now, there's a flight to quality, for
Yep.
sure. In there's a C class play before too long. I don't it C class stuff's getting beat up pretty bad, so there might be a play at some point. I think right now, and we just buy A and B. So,
Okay.
but on the C class side, there might be a play before too long. My concern, like, if I'm just putting my investor hat on, I just don't know what the exit cap is going to look like, because
Mm.
it feels like it keeps on getting pushed up further and further, and so I just don't. I want to back up by saying in 21, yeah, it was 21 when things were super, super hot. So the
Yep.
cap rate between an A, B, and C deal were basically all on top of each other.
Oh my God.
And
Yeah.
so for us, we're like, why should we go buy this older stuff? We can go buy the newer stuff and basically get a similar return. Like, there's
Yep.
no, there's a lot more risk. There's, pipe, older pipes, older electrical.
Hmm.
Insurance is a risk. I mean, there's tons and tons of risk, and so we need to see outsized returns in order to, go back into that C. So we're just A and B, and we like that. And we're just, super honed in on location.
Yeah. Yeah. Okay. So, man, tell me what it's been like. You've mentioned, okay, what it was like buying stuff in 2021 to 2023. You've had some of those. You've had some of those struggles,
Mm-hmm.
but I know you're still buying. Like, I get your emails. So,
Yep.
what has acquisitions looked like from like 23 to 25? Now we're mid 25.
The last, the deals that we're looking to do, we really want, we got beat up on bridge loans like everybody else did.
Yep.
And I guess thankfully we tried to have plenty of capital and all that, so that kind of helps. And then we bought 3-year caps. That helped too, because some people didn't buy caps. We frankly went into foreclosure pretty quickly.
Mm.
Not maybe not all of them, but at least a lot of them that I heard
Yep.
about. Or some people bought 2-year caps, and they're caps are not cheap.
Yep.
Just the cap is a factor, is based on the value of the loan. And so, if you got, I mean, we've spent $2-3 million on caps.
Oof.
Like, if we have to re-up a cap for a year, it's $1 million. Like, it's no
So
joke.
that's
So,
basically to renew a loan, to extend a temporary loan. Is that what you're talking about? Like, you come
so
up to the.
the interest rate cap. So, um, excuse me. So let me take a drink here. Just one
Yeah, you're
second.
good, man. Um, that Yeah,
So,
the
the
commercial loan products can be expensive when you're doing special stuff.
yeah. So the way it works is, so the interest rate it's like 8-9%. And so to bring that down to a more palatable level, so you buy an interest rate cap, and so to bring it down from, let's just say, 9% down to 5%. So you buy an interest rate cap. Your cap basically pays you the delta between that 9% and the 5%,
Okay.
and that pays the lender every month. And so basically, it brings down your effective interest
It's like
rate to 5%.
subsidizing the interest payment, essentially.
Yeah. You're prepaying some company to take the risk that the interest rates would go back up,
Yep.
basically. And so anyways, we bought 3-year caps. That helped. Some people bought 2 years, some people didn't buy a cap.
Mm.
But yeah, we're going the deals, at least kind of, we're not completely opposed to bridge loan, but the deal needs to be really attractive
Mhm.
for us to want to go that way. So we're doing agency fixed rate debt, that you can get that for 5.5% right now, which
Okay.
is really attractive. You can get 5 to 7 year loan. You can get a 10-year loan if you want to.
Okay.
But yep, that's kind of doing agency is probably the preferred method for us
Yeah.
right
So
now.
you're locking in your interest rate. You're removing that variability. Um, what does it look like on the deals you're looking at? Because if I recall correctly, and it might have been your Houston one,
Mm-hmm.
I'm thinking that you bought that below what the prior owner had bought it for, or there was something there that's like, wow, that is unfortunate for the seller,
Yeah.
but it looked like you were getting a pretty good A-class product for a good price.
Yeah, we purchased some deals, pretty close to close to where, it's a pretty major equity loss, unfortunately for them. And then some of the guys that we're buying from coming up, they've owned for a while,
Okay.
so they're just not making near as much as they were hoping to make.
Okay.
So, but they have either a loan maturity, or they may have some, hurt, throughout their portfolio, and they're just,
Okay.
needing to move equity
So
around.
they might have bought in 2020. They're coming up on the end of a 5-year loan,
Hmm.
and they're going to make money, but not what they thought they were going to make 2 years into
Right.
the deal.
Yep. Yep. Yep.
Okay.
Yeah, exactly. Yeah.
Okay.
So.
Now, is there anything other than using, agency fixed rate debt? Is there anything different about, how you're approaching multifamily properties now? Sounds like A class where you were already doing A and B,
Hmm.
but as a passive investor is listening or talking to syndicators and GPs, what do they need to be thinking about how the person they choose to invest with is making their decisions?
Yeah, I think you should kind of look at their track record. I
Yep.
think that is helpful. I don't think I would solely make a decision, yes, yay or nay, based on that. I would, I think seeing how their current stuff is operating.
Mhm.
I think you know um, getting to know people in general, and trying to everyone has a good resume, or at least most people do, or they can hire someone to make it look good. And so I think just really getting to know people is helpful. I think talking to getting referrals and all that, you can get them from the sponsor, but the better referral, honestly, would be the ones that you kind of seek out a little bit, because usually, if you know, um, someone's giving out referrals, it's usually sometimes their friends or like their
Yep.
best investor type of thing too. So, I think just kind of just getting to know people. I invest passively too,
Yep.
and one thing that if people just reach out on LinkedIn or like, hey, you want to invest in this deal, I'm like, who are you? like, yeah, sure. Yeah, here's 50K, I mean, like
Yeah.
that. I don't know. Anyways, for me, I'm like, I don't know. It's turn off. But so I think just getting to know people, is very helpful. The people that I've kind of invested with, I mean, honest, and we talked about this before. Like, I've invested with people that they checked every every box,
Mm.
and I'm not trying to scare people off, but like, they were fraudulent, and did everything I possibly could. I mean, I talked to people who invested with them for like 5-10 years and blah
Yep.
blah blah, and so did everything I could, but again, not trying to scare people, because there's a lot of really really good people out there, and I really enjoy. I think the level of professionalism. Like, I
Mm.
think there's a lot of really good quality people in this space, honestly. And so the person I had invested with, that I was anyways, they ended up going to jail. So, but
Oh,
and they were not in the multifamily space too. So, but yeah,
you're
it
the
was.
second person on here who's had someone go to jail or knew someone who went to jail.
Yeah,
So
yeah,
yeah,
yeah, yeah.
that's
So,
great. Well, not great, but
yeah, but
funny to hear. Yeah.
I mean, the one thing about things being hard is it's a filtering process right now, and we were talking
Yep.
about that, and I think, which is good for the industry. You had a lot of people, jump in. Oh, cool! I can go make some money, or I don't like my job. I'm gonna go quit and go do this. Like,
Yep.
I don't know. I mean, I had a W-2. I tried to slowly kind of work my way out. I, had seen people that, kind of, you hear people burn the boat or burn the bridge or whatever. And I think there's, it's good to, kind of get off the ledge and to, to go take action and all that.
Yep.
But at the same instance, I think you need to be smart about it. You don't want to force yourself to go buy deals.
Yep.
And I mean, honestly, like, we don't have to go buy deals, but I think, everything in the stock market's high. It's not as, I'm not a stock market guy, but the
I'm
whole
not
logic
either.
is,
Yeah.
don't buy high. The stock market or multifamily is low right now. We've seen a massive cut, and I think we're seeing some really good opportunities right now.
Yeah.
So I think it's, and it's an inverse effect of interest rates are high, which drives up cap rates. And so when you want to buy at a higher cap rate as opposed to a lower cap rate, and so
Correct.
you can kind of think about it that way a little bit.
Yeah. Talk a little bit about what you see happening, or why, other than just we might be kind of low right now. What do
Mm-hmm.
you think is going to be the good time to buy, or why is that coming up? Tell me a little bit about what you think the next year or two of multifamily is going to look like.
Yeah.
Pull out your crystal ball for me.
Right. Yeah. Yeah. I think it broke a long time ago, but
Yeah.
but yeah, I if I had a crystal ball, I would have bought everything into the sun in 2014 through 18.
Yep.
But yeah, I think it's a really good time. I don't know how long it'll last. I think everything has been kind of pushed out further than everyone was anticipating. We go to
Yep.
NMHC every year. That's the National Multifamily Housing Conference. We go to basically get a temperature on where everybody is kind of thinking things are going, and everybody's
Mhm.
been wrong, honestly. And so maybe I shouldn't go next year, but I think that because everybody thought rates were going to be cut more drastically than they have been,
Yeah.
and that would help accelerate the recovery of multifamily. It's been very slow. Now,
Uh-huh.
if Powell gets pressure from the president, or gets
If you mean if he
gets the
does
pink
anything about
slip,
the pressure.
then yeah, or if
Yeah.
he gets the pink slip, then
Yeah.
maybe things will kind of accelerate. But everything's been pushed out. So I think the right now we're seeing some phenomenal deals we haven't seen
Yep.
in a long time. and even in DFW, which is the most, just so you know, it's the most competitive multifamily market in the country.
Mm,
And we're seeing some phenomenal deals in Austin too. And we're seeing some really, really good deals in Houston. So I think it's a really good time to buy. I would just, just get to know people that you're investing with.
yeah.
Ask, don't be afraid to ask, the hard questions and things like that. But yeah, I think just taking the time to get to know people is very helpful. And you spent, I mean, my first job out of school, I got paid less than $50,000 a year. So when
Yeah.
you're investing 50 grand, like that's a lot of money. And be respectful of your time and your efforts that it took to collect that money. And
Yeah.
so I just would take your time and getting to know people.
Okay. Well, cool. Before we wrap up, I want to transition. I want to hear about you and your your multifamily team you have, Momentum Multifamily. Tell me a
Mhm.
little bit about the team that you work with and, what you guys are working on right now.
Yeah, yeah. Yeah, so I'm in DFW. My business partner, Hayden Harrington,
Mhm.
is down in Houston. So we met. He used to live up here. Now he's down in Houston with his wife, and he's from there, and his lots of family around there and all that. So we're just focused on these two markets. We know both of them. I grew up here and he grew up
Mhm.
down there. We know them like the back of our hand. And we just want to do our whole job is to take out as much variability and to we want investors to win. We're competitive. We played sports, still
Yeah.
play sports. We want to win too. And so we just want to, in our minds, we take care of our tenants, take care of our
Mhm.
staff, and everything else will fall into place. But we have an asset manager full time between him and Hayden. They're at the properties usually every week. We meet with our managers every week as well. They have to fill out, it's called WMR, weekly management report. It's
Okay.
a custom thing that we put together. And all of this is just for, really, it's for accountability, and it's for, we want, no matter what manager comes in, or if we were to switch management companies or whatever, we want to make sure the train stays on the tracks. We want to
Yep.
make sure there's as little variability as possible, just so everyone wins and we're not pulling our hair out. So but and then we have an operations manager. She's up in Keller area. And then we have a bunch of different, they're not under Momentum, but we have a bunch of different long-term partnerships with
Cool.
different folks that we've worked with. So,
Okay, cool. And now are you guys working on any projects right now that you are either potentially raising money for or in the process?
yeah, have a deal, working on, and then we've done, some other funds and things like that
Okay.
too. So, yeah, always happy to chat with folks. Always happy to help. I mean, the way I've kind of seen it, I mean, we've had people on our investor list for 10, 15 years, over a decade, where
Mhm.
I started going to all these different meetups a long time ago. And it's amazing, like sometime, like I remember I was pretty excited. I had a few people that have been on my list for a decade that just kind of recently invested. I'm like, wow, okay. And then have had a few people from my high school and when I grew up. I'm like, oh, okay. So now you're on. I've been doing this for over a decade. Deal number 18, and so
They're
you're
finally trust
finally,
you enough.
finally, yeah, finally. Okay. They're like, oh, okay. It's
Yeah,
not a fluke. Okay.
that's funny. Okay.
So yeah,
Well, tell the listeners, and if you don't have anything that you're actively taking money for right now, that's fine. But
yeah.
what might you like? What's the general ballpark of what you're aiming for? How does that work? So someone kind of just gets the general top level. Cool. Hey, I want to reach out to Dustin.
Right. Yeah. So We were looking for, in general, a 15% IRR. We're looking at 6% average cash on cash
Okay.
over the life of the deal. We're looking to hold deals around. We always tell people around the 5 year mark or so. Our preference would be to hold longer, but sometimes if we like there's one or two deals that we own or buying that we're like we think we could make could be a good win for everybody. So but those are general parameters in Houston. 90s and newer product. We're outside of Beltway 8 is the way. We're very kind of very picky, very structured on that side. And then
Okay.
in DFW, it's 80s and newer. And the reason the difference in age is just because of the way the two metros have grown and all that. But
Okay.
really focused on location, location.
Yeah.
So yeah, and we do monthly updates. Just we want to just work with good folks and provide an attractive return for people.
Okay. Awesome. Well, Dustin, thanks for being on. What's the best way for a listener to get a hold of you?
Yeah, absolutely. So my email is just dustin@momentummultifamily.com. Our website's momentummultifamily.com. I'm on LinkedIn,
Okay.
just Dustin, middle initial W, Miles. So yeah, happy to
Cool.
help, happy to chat.
Awesome. Well, we'll get all that in the show notes. Hopefully, we got clickable links for people to make it easy for them. They don't have to spell anything. But Dustin, dude, thanks for being on here. And last question, and we're going to wrap this up. What are a couple of red flags that you would tell new investors to look out for, specifically on multifamily deals in today's market?
Yeah. I guess so. We were talking earlier about preferred equity and all that. And there's a number of preferred equity funds out there. So I would want to understand, like we were talking about, if you bought a deal in 21, 22,
Yep.
23, and you're putting preferred equity on there, how if the deal's already honestly kind of struggling, like how are you producing cash
Yeah.
flow
If you need
magically?
to raise money, how are you going to pay it back?
Yep.
Yeah.
Yep. And so if it's just, oh, rents are going to be increasing and
Mm,
all like that, I'm not personally, I'm not excited about that. And so so one, and we've created one and all that is, we had a tax abatement. So
yep.
our property taxes were $1 million. And now, there's some other fees, but like,
Yep.
we'll say 800,000's wiped out. Well, that's a lot of cash flow
Yep.
per year. And so you can afford to pay for that, that current yield is what they call it. So,
Yep.
I would look out, for that. I would say, if people bought stuff in 21, 22, and 23, like June of
Yep.
21 on, because that's when it got really competitive, and they haven't had any complications or whatever. They're like, oh, everything's good. Then I would, and they bought a deal during that period, I would be like, well, did you buy a deal during this period? And if so, can you tell me about it? And
Okay.
so I would, if everybody's like, oh, everything's good, don't look over here. That's kind of, everyone is going. If you buy a deal during that period, you've had to figure something
Yep.
out. Um,
Everyone's going to have at least a little bit of a hickey, a little bit of a black eye.
yep.
There's going to be some struggle they went through.
Everyone lost 25% of value. So how did you solve for that?
Yeah.
Um,
How'd you survive
yeah,
that? Okay.
yeah. And so, um, you know, a lot of people, I think the tax abatement thing, I mean, honestly, helped us a lot.
Yep.
And some other people have done other things to help kind of, financially engineer all of that. But, I think just that and communication, constant communication. I've seen some sponsors or heard of sponsors not communicating. Like I'm passive in some deals, and I'm passive in when people, I don't get updates. I'm like, what's going on? So um Anyways, there's probably some other red flags I'm not
No,
thinking
those
about,
are
but
good
those are
ones
a
though.
few off the top of
I've seen
mind.
a lot of guys talking about preferred equity, talking about coming in to essentially, hey, we're gonna provide some additional funds for deals that have good operators but need some capital, right? And
Mm-hmm.
oftentimes that ends up being some sort of preferred equity, some sort of, I don't know, mezzanine debt. A couple times what I've found out is someone just set up a separate fund to raise money for their own deals that are struggling, but they're
Yeah.
not super upfront about that. So
Right.
yeah, thank you. That is a good one. Double
Yeah.
check, how are you going to pay this out? I'd say I'd add, make sure that the preferred equity they're raising for isn't just straight up a repayment of a GP loan, maybe.
I've seen that too.
Yeah.
Yeah. Yep.
So,
Yep. For
but
sure.
okay, dude, Dustin, thank you so much for being here. I enjoyed it.
Okay, so I want to give a big thanks to Dustin for being on the show today. And really, I had two big takeaways. One is that really in a good market, any operator can look good. I know of at least one specifically, and there was a whole bunch that were incredibly highly thought of when the market was going good. And when the market turned, it all came crashing down around them. Dustin is not one of those guys. Like he mentioned, they have had some tough deals to work with, right? There's been some ways they've worked through those. But Dustin has been around, will continue to be around, and I've enjoyed getting to know him over the years. So the other thing that we dove into a little bit was these tax abatements and preferred equity. So if you are looking at deals that revolve around either of those items, you should do some extra due diligence, double check that, figure out what the pros and cons are, figure out how they're making that work and what the likelihood is that that will continue to work the way they're saying it is through the life of the investment. So if you have found this helpful, please hit that subscribe button, share it with your network. And if you're looking for more people like Dustin, or you want to meet Dustin or me, check out the Passive Investor event. There's a link below. That is something that really the cost of the ticket is inconsequential considering the value and the education you're going to get and the contacts you are going to make. So I hope to see you there. And if not, I'll see you on the next episode.